In a game-changing move, the US government goes all in on Bitcoin mining. With 40% of the total hash rate, the US now leads the charge. Industry expert Jaron Mallard sheds the light on this seismic shift. Stay tuned as we explore the implications of America's strategic bet on Bitcoin mining. Don't forget to subscribe, like, and share, and let's start. So let's talk about the Bitcoin halving and post-halving. First of all, I've seen many people here on CT predicting a discount on alts, and some say a minus 50% discount from the CMP. To provide a thoughtful comparison and assess the potential impact of the upcoming Bitcoin halving on the market, including a possible 50% downturn in altcoins, let's first review some historical context around the Bitcoin halvings and their past effect on cryptocurrency markets, then analyze the current data and the ETF catalyst. Historical context of Bitcoin halvings. Bitcoin halvings are a scheduled event that occur approximately every 4 years or after 210,000 blocks are mined, reducing the reward for the mining new blocks by halving, as this mechanism is built into the Bitcoin's code to ensure its scarcity, mimicking the process of halving the supply of a resource like gold. Historically, halvings have had significant impacts on the Bitcoin's price and the broader cryptocurrency market due to the reduced pace at which new Bitcoins are generated, which can lead to a supply shock if demand remains steady or increases. So post-halving and market response. First halving 2012. The first Bitcoin halving occurred in November 2012, reducing the mining reward from 50 to 25 bitcoins, as the event was followed by a significant bull market in 2013. Second halving 2016. The second halving in July 2016 saw the mining reward drop from 25 to 12.5 bitcoins, as this was followed by a bull market in 2017, culminating in Bitcoin reaching nearly $20,000 in December 2017. As the third halving in May 2020 reduced the reward from 12.5 to 625 bitcoins, and despite the initial uncertainty, the year following saw a significant bull run, with Bitcoin reaching a new all-time highs. Analysis of current data and trends. To assess the potential impact of the next halving and whether a 50% downturn in altcoins is likely, we need to consider several facts. Supply and demand dynamics. The halving reduces the rate at which new Bitcoins are created, potentially leading to supply constraints, and if demand continues to grow, this could push prices up, not down, as market sentiment and external factors, the broader economic environment, regulatory changes, and technological advancements in the blockchain space can significantly influence the market sentiment and the price of Bitcoin and altcoins. So, historical patterns versus future predictions. While historical patterns suggest a bullish trend following halvings, each cycle is unique and past performance is not indicative of future results. Factors such as market maturity, increased institutional involvement, in this case the Bitcoin ETF, and a broader adoption of cryptocurrencies could affect the outcome differently this time. Given these considerations, predicting a 50% downturn in altcoins post-halving is speculative, as altcoins tend to follow Bitcoin's lead but with higher volatility, as a downturn could occur if the market reacts negatively to external pressures or if the halving leads to a short-term sell-off. However, the long-term impact is harder to predict and could just as well be bullish if historical patterns repeat. The question now is, what will happen differently in 2024? The next up we go for Bitcoin at 61,000 is imminent. If the AB equals CD pattern were to play out, Bitcoin would reach the 61,000 sooner than many could actually expect. The Bitcoin price is currently trading at a 1.45x as the 200-day moving average price. The last time this ratio moved above 1.5 was November 2020, and historically it's been a good indicator for the start of the bull market as well. That's a really great sign. Not listening to my financial advisor, best move. Bitcoin education is better than any financial advice. So 5 years ago I made an appointment with a financial advisor, Charles Schwab, to transfer my traditional retirement account there. I only knew Bitcoin was the magic digital internet money and really wanted to buy some, or at least incorporate some of it into my retirement account. During the advisor's chat with me, I asked him what he thought about Bitcoin. He said, "Don't ever use the B word with me or anybody in this office." His face turned red and he truly acted angry and offended. I stood up and walked out. Later that day, I bought and read the Bitcoin Standard and dove head first into the videos, podcasts, etc. 6 months later, I put everything into a multi-sig retirement account and have never looked back. The best decision I ever made. The next 4 is the Bitcoin ownership distribution. So Bitcoin ownership distribution for February 2024, we have 714k Bitcoins is 3.4% is miners. Satoshi's 1.1 million Bitcoin is 5.2%. Then we go for lost Bitcoins by estimation is 17.6%, which is 3.7 million Bitcoins, which is already makes supply way lower than the actual 21 million that we have for all time, and more can be lost in the future. 81.7 to 130.4 million individuals hold 12 million Bitcoins. Businesses, 758,000 Bitcoins, 3.6%. Funds, ETFs, 818,000 Bitcoins, which is 3.9%. Then we go for governments, 565,000 Bitcoins, 2.7%. And a 6.6% is still to be mined, which is 1.3, almost 1.4 million Bitcoins. Next up, Mr. 100 is active again, buys 100 Bitcoins several times again. And there's the chart from September 2022 and updated for 2025 from 15,000 to 53,000 in just 1.5 years. Wow, if you're curious about investing, the best way to read the market is to be a trader. US dominates Bitcoin mining as global hash rate distribution evolves. So the global landscape of Bitcoin mining is undergoing a significant shift, with the United States now leading the charge, commanding an impressive 40% of the total hash rate. China, once the uncontested giant in the field, now holds 15% of the mining power, followed by Russia 12%. This information, highlighted by industry expert Jarin Mallard, reflects a dynamic and rapidly changing sector. This geographical distribution of mining power has notable gaps, particularly in Africa and Latin America, which currently contribute minimally to the global hash rate. However, industry forecasts suggest that these regions are on the cusp of the transformative rise in cryptocurrency mining activities within the next 1 to 2 years. The current distribution presents a stark contrast to the historical concentration of mining power in China. Policy shifts and regulatory crackdowns have distributed the hash rate across the globe, with countries like Kazakhstan and Malaysia also emerging as significant players, each contributing 3.5 to 3% respectively, and the United Arab Emirates is positioning itself as a new hub, accounting for 3% of the global hash rate. So the movement of Bitcoin mining into diverse geopolitical areas is not only a testament to the resilient nature of the network, but also signals a broader acceptance and integration of cryptocurrency mining into various economics, as this decentralization of mining operations is critical for the stability and security of the Bitcoin network, ensuring no single country can exert undue influence over the blockchain. And as the industry continues to evolve, eyes are on the regions like Africa and Latin America, where untapped potential and the promise of economic benefits could lead to a surge in local mining operations. The expansion of Bitcoin mining into these territories is poised to offer a more inclusive and balanced global hash rate distribution, strengthening the backbone of the world's premier cryptocurrency. That's all the information we have for today's video, so don't forget to subscribe, like, and share. See you in the next one, and peace.